The GCC states have decided together to implement VAT as part of their revenue diversification objective. The GCC VAT Treaty sets out the broad principles of VAT, and each country enacts the treaty by passing their own VAT law. The Federal Tax Authority will be responsible for administering VAT and other federal taxes. This includes providing guidance, collecting VAT, and conducting audits. So, what is VAT? VAT is a tax on the transactions of goods and services. VAT is applied at each stage of the supply chain and is due on the value added at each stage. The standard rate of VAT will be 5%. This factory buys dates to make date syrup for 105 dirhams. 5 dirhams of VAT charged by the supplier is given to the FTA. This shop buys date syrup from the factory for 210 dirhams. 10 dirhams of VAT is given to the FTA. However, the factory reclaims 5 dirhams of VAT from the date purchase. The customer buys the date syrup from the shop for 315 dirhams. 15 dirhams of VAT is given to the FTA. However, the shop reclaims 10 dirhams of VAT from their date syrup purchase. The customer cannot recover VAT as they are not a taxable person. The VAT was collected in stages by the businesses in the supply chain. VAT is not a cost to businesses, but cash flow should be managed. The supplier, factory, and shop will file a VAT return with the FTA to document the VAT it is paying and reclaiming. As well as the 5% rate, there will be a 0% rate. Other supplies will be VAT exempt. Businesses that supply zero-rated goods and services can claim VAT back on expenses. These businesses would be in a net refund position. Businesses that supply exempt goods and services cannot claim VAT back on expenses. Some businesses will be required to register for VAT. Others will have a choice, and some may not be able to. For further guidance, please contact the UAE Federal Tax Authority.